Well, good morning, everyone. Thank you for being here for our annual economic update. It's been an interesting week, to say the least. So we're obviously quite glad that you're here. I'm sure that there are going to be some questions. We've already had a few submitted, and I'm sure that you probably have more on your mind. So the chat box is available, and I'll keep mentioning that as we go through this morning. We have a really great presentation today. It's kind of neat having our annual economic update. We always enjoy that. But we hope to give you a general overview of the key issues impacting the U.S. As well as the global economies. We're focusing on the areas that will impact most of our attendees. That's really key for us. And fortunately, we know you and know the things that are very important for you. Please note that your questions, and of course there will be ample opportunity at the end of the presentation today. Matt and I will be fielding those questions and hoping to give you some answers and a good sense of direction. Let's review the quarter of credits, the child credits that were out there, stimulus, recovery, growth, change, many different options and items going on in the world, to say the least. When we had our annual economic update a year ago, the vaccines were just beginning to be rolled out. If you'll recall, they were being administered. Delta was an airline. Omicron was a Greek letter that no one knew. The U.S. economy was awakening. We had unemployment beginning to decline. We had low interest rates. That was really good. The stock market was hitting new highs on a regular basis. Americans were working from home. Church, work, and school were still online. Americans shopped online, and they're very good at that. They ordered from restaurants online. They wore a mask to go out in public. And then when we had our third quarter economic update just 3 months ago, vaccines were becoming minimal. The U.S. economy was beginning to roar, creating a new item to keep an eye on: inflation. We had unemployment continuing to decline. Everywhere you went, there was a help wanted sign. We still had low interest rates. The stock market was still hitting new highs on a regular basis. Americans were working from home and the office. Church, work, and school were back to in-person again. People shopped wherever they wanted, and online shopping was still strong going into the holiday season. People shopped wherever they wanted to. They ordered from restaurants online. They were actually starting to dine in person. Restaurant attendance was moving up very rapidly. They sometimes wore a mask in public. Wow, what a new norm. So what does this mean? Well, to help us figure this out, I have, and of course, develop a future game plan. I want to make sure that I bring in and introduce Matt Treskovich, our Chief Investment Officer with CPS Investment Advisors. Matt, can you help us out here? We need some insight and a good sense of direction.
Absolutely, Marshall. Good morning. Good morning to all of you. It is great to be back and talk to you again. Thank you for joining us today. So I am Matthew Treskovich. I am the Chief Investment Officer here at CPS Investment Advisors. And we're going to talk about all of the reasons that are out there to be optimistic about stocks. Despite a lot of the negative news that has come up recently, despite the market sell-off that we've had to start the year, there are plenty of reasons to be optimistic about stocks. So for long-term investors, we'll take a look at those. Just to recap what the market did last year, 2020, of course, was a great year for stocks and a great year for bonds. The S&P 500 was up almost 20%. The tech-heavy NASDAQ had a home run performance, and the aggregate bond index also did very well. 2021 was a little bit more of a mixed bag. The S&P 500 was actually the best performing of the three major benchmarks, while investment-grade bonds and the aggregate bond index both actually had negative years because interest rates were starting to rise. Diving down into what the various sectors of the market did, energy was the best performer last year, and that's, of course, because it was among the worst performers the year before. Real estate also turned in a healthy performance, as did financial companies, communication services companies, technology companies, and essentially every other sector of the market had a very healthy 2021 performance. Looking down the road, there are 4 factors that we see driving the markets in 2022. First and foremost, the Fed, inflation, and consumer spending. Corporate earnings are going to continue to be very important, as are supply chains and the upcoming midterm election. One of the things that's not on the list in terms of economic drivers or stock market drivers is COVID. Looking at the total number of vaccinations and the total number of people who have had immunity through having had COVID, it's pretty clear at this point that the pandemic has subsided and COVID is now an endemic disease. It's something that U.S. consumers can and will learn to live with and continue their lives. It's not likely that future waves of COVID will impact consumer behavior the way the first wave did. Even a global pandemic has not been enough to stop the U.S. consumer. Consumer spending has grown healthily every one of the past several quarters, and we see that trend continuing. People have money, and they're continuing to spend it by all accounts. U.S. consumer spending continues to set records. Last year, consumer spending reached the pre-pandemic level and then continued growing, and has continued growing since then, and is now continuing to grow at a very healthy clip. This is a very favorable sign for the future economic prospects and for the prospects of the kinds of companies that we invest in to be able to continue to make money, which is ultimately good for us as investors. The question we need to think about is, can consumers keep spending? And all the data tells me, yes, consumers still have plenty of room to continue their spending spree. The personal savings rate is still above pre-pandemic highs. It has come off of where it was at the depths of the pandemic, but U.S. consumers are still saving more than they did before the pandemic, as hard to believe as that may be. Household debt service is also lower than it was pre-pandemic. About half of the decline in household debt service has been reversed, which means that consumers both have cash in the bank and they have the ability to borrow to continue spending. And if we know one thing about the U.S. consumer, it's that if there's the ability to spend money, it very likely will be spent. Unemployment is now at pre-pandemic levels. Weekly jobless claims are essentially where they were before the pandemic. And what we hear from our clients is that the number one challenge facing businesses, small and large, is it's tough to find people who want to do the work. People are changing jobs at a record rate. This is another excellent sign for consumer confidence, because people won't leave a job without knowing that they either have the money in the bank to sustain them and or a better job already lined up. Labor force participation is improving, but slowly. The number of people who are permanently out of the workforce seems like it is going to be higher for the foreseeable future, and a slight decline in the labor force participation rate is something that employers are simply going to have to learn to live with. The labor force participation rate challenge is something interesting. If we listen to the news stories and listen to people talk, the millennials are the cohort that is getting all the blame for that. The millennials quit their jobs and they're living in vans down by the river. That seems to be the story that is passed around. But when we actually look at the numbers, we see something very different. That labor force participation among the 16 to 24-year-old cohort and the 25 to 54-year-old cohort has been steadily improving since the bottom of the pandemic. What has not improved is labor force participation among the baby boomers, those who are 55 years old and older. And that's actually a far bigger contributor to the labor shortfall than what's happened in the younger demographic categories. That wave of early retirements represent people who will not be coming back into the workforce, which means that labor force participation may be a little bit lower than it was on a forward basis. And it's something that businesses are going to simply have to learn to deal with. The jobs gap is continuing to close. There are more than enough job openings for employment to return to pre-pandemic levels. But again, the challenge is simply finding people who want to do the work. One of the things we've been watching closely are whether oil prices and inflation are going to truly hurt the economic recovery. Oil prices are up about 100% from where they were a year ago, give or take, which seems like an extreme move in oil prices. But one of the things we need to think about is what would oil prices look like if they simply stay the same over the next few months. And actually, I think the number is probably 5 months or so. If oil prices are basically flat for the next 5 months, then suddenly this year-over-year change and the year-over-year inflation number that results from it will actually be zero. So that's a sign that if the Fed can simply hold the line, that inflation should be subsiding this year. What we do know is that where consumer spending goes, corporate earnings will follow. As investors, we like to invest in companies that have a track record of making money, creating capital, and returning a portion of that to shareholders. So steadily increasing consumer spending should lead to steadily increasing earnings and ultimately benefit us as investors. Earnings are actually higher than they were pre-pandemic. Wall Street analysts remain fairly pessimistic about what earnings could look like this year. If you look at the chart, the red bars represent Wall Street analysts' earning estimates for the third and fourth quarter of 2021, as well as the 4 quarters coming up this year. If you take the bottom up Wall Street analyst estimates, Wall Street actually expects corporate America to earn less in the fourth quarter than it did in the third quarter and in the second quarter of last year. That seems very unlikely to me, especially in light of the GDP growth numbers that were released this morning and the walking around sense that we get simply by examining what people are doing and where they're spending money. So there is plenty of room for earnings to beat these expectations and continue growing. And of course, we like to see companies create capital, as I said, and return that capital to shareholders. The primary way that companies return capital to shareholders is through dividends. We like to see dividends that are paid consistently over time and grow over time. Stock buybacks, responsibly done, are another important way that companies we invest in return capital to shareholders. And what we're seeing is that stock buybacks are returning with a vengeance. When times get tough, companies typically don't buy back their stock, but when things improve and they have a more stable future outlook, they will return some of the capital that they've hoarded by buying back stock. And we're seeing that companies have returned to that pattern post-pandemic, and this should provide a tailwind to equities. The long-term economic growth trend in the United States is still intact. We have reached the pre-pandemic trend line and actually exceeded it. So by all accounts, the U.S. economy is actually very healthy and growing at a very healthy clip. Supply chains will continue to be an issue. Fortunately, we did not see the empty shelf Christmas that was predicted. There were goods on the shelves. People were able to get out and find what they needed or find adequate substitutes and buy them. We're also seeing that inventories are recovering. U.S. business inventories are ticking back up again, and the ratio of inventories to sales has turned around and is once again headed in the right direction. So by all signs, all the data is pointing to supply chains that are indeed functioning and slowly catching up with the incredible demand that we've seen from the U.S. consumer. So, was the market due for a correction? Apparently it was. The market has sold off as of this morning, roughly 9% year to date. I believe it did dip briefly into correction territory earlier this week in some of the indices. But that's not something we would try and predict in advance. We know that corrections can happen at any time, and ultimately in the long run, corrections are a buying opportunity, not an opportunity to sell stocks. We know that the market drops 30% from a high about once every 5 years, and that it averages 14% drop annually. Now, we had our 30% drop from a high 2 years ago. That was March of 2020. Is it likely that that will happen again this year? It could. Is it certain? It's by no means certain, but if it did, again, that would be something we would consider normal market behavior. We know that over long periods of time, investing in dividend-paying, high-quality companies is the best way to beat inflation. And we also know that selling low and buying high never works. So our advice to our clients is turn off the TV, don't look at your account, don't make important decisions based on emotions. We know that the markets go up almost 3 out of every 4 years, even though daily dips of 2% or more occur 5 times a year or more. And just about every year out of the past 40, there were times when things seemed scary and times when the market had a correction. And you might have thought, if you were living through that time, that it'd be a good time to sell stocks. History shows that that has never been the right decision. And even in the best years the market has had in the past several decades, there have been points where the market was showing a negative return for the year. So the lesson to investors is that you have to be able to hold through those occasional dips in order to realize the long-term returns that the market makes available to us. And again, going back just through the last 20 years, we can find plenty of reasons not to buy stocks. This year, reasons might be, well, the January effect. The market's having a correction in January, and that means the rest of the year is going to be bad. Or it might be the midterm elections or turmoil in Eastern Europe. There are always plenty of reasons to not buy stocks, but in the long run, none of the reasons on the screen were ever a good reason to be out of the market. And if you had sold because of what was happening in the world in 2013 when the Fed was tapering, or in 2012 when there was a debt crisis going on in Southern Europe, you would have been doing the wrong thing at the wrong time rather than staying the course and staying invested in high quality companies. The long-term bull market cycle is still on track. When we look at what the market has done over the past 2 years, it really hasn't been that different than what the market did during the 1980s bull market and the 1950s bull market. So even if the market does experience a correction here, we would consider that to be completely normal and healthy behavior, and we still believe that the long-term bull market cycle is on track. And of course, I tend to spend a lot of time talking about investments, but that's just one small piece of the financial puzzle. You actually have, or we have, no control over what the market is going to do. We can control whether we are invested in the market and what kind of companies we're invested in. We have control over how much we spend and how much we save, which is just as important, if not more important, to our long-term financial health and to our financial independence as what the market does. We have some control over our earnings and our employment. With good planning, we can have a little bit of control over our taxes. With some strategy, we can have a little bit of control over what Social Security pays us, but not a lot. And ultimately, we simply need to focus on the things that we can control and have a plan and have great advisors to help us with the things that we can't. So with that, Marshall, I will turn the floor back over to you.
Thank you, Matt. Wonderful presentation as always. I'm sure everyone picked up some good pointers of that. I'm going to drill down a little farther into the economic update and give us some thoughts and insights that I hope you'll find informative. Kind of where are we and what are we looking at as a first quarter? It's hard to believe we're almost a third of the way through the first quarter, but to properly do this presentation, of course, we need information that comes out as late as 8:30 this morning. So when we give you this presentation, it's pretty timely. The economic outlook for this coming quarter, the business cycle is mid-cycle. Corporate earnings continue to show strength. We've got unemployment that Matt has talked about, I'll talk about further, and interest rates all impacting everything as a mid-cycle of the business cycle. We've got geopolitical tensions. I'm going to look at a few of those, and actually there's another one that cropped up this morning that I didn't have on the list I'll talk about. Interest rates, they're low, but as of yesterday afternoon at 2:30, we're anticipating those to move up. Inflation is high. I don't think by anyone's standards it's not high. It's not as high as many of the people on this call have experienced during their lifetime. I remember the late 70s, early 80s, and the 18% interest rates. So I know what high inflation can actually be. The unemployment, you'll see the numbers on that. Matt's talked about it. I'll give you a little bit more. Unbelievably at a historic low. Liquidity is high, and the demand it just amazes me the pent-up demand that we have in the U.S. consumer. So what are those geopolitical tensions? Well, from a COVID/economic standpoint, Europe is in a lot worse shape than the U.S. They have not had the same levels of stimulus, the same levels of distribution of vaccines, and they're not quite back to really where we were even a year ago in many of the European countries. Third world countries, there's comments that they may take at least a decade to recover. So there's tremendous opportunity in those countries for recovery and for healing. And so we're very positive of what can happen in those countries over the coming years and opportunities to retool. Russia versus the Ukraine, this is one that everybody, if you've watched the news at all the last couple of weeks, you've probably got one eye on Russia and the Ukraine. And then now this morning, report of a couple of missiles coming out of North Korea. We can add North Korea to the list of just the standard list of geopolitical tensions that we just have to constantly keep an eye on. It doesn't look like there's anything dramatic in the short term, but are we going to just do a nasty look standoff in Russia and Ukraine? Is South Korea just trying to show their North Korea just trying to show their strength? All that will play out in the coming quarter. Interest rates are still interesting. The 10-year Treasury is up to about 1.8%. The 30-year mortgage is about 3.9. These interest rates have made it very interesting because the Treasury has jumped about 0.75% since October, and mortgage rates are up over 1% since October. So these are items that are real challenges to come into the marketplace. One of the interesting things is first-time home buyers coming in and needing down payments on those 30-year mortgage and with new higher prices on houses. So there's some real challenges going on in the housing market from a lack of supply, interest rates increasing, and the first-time home buyer not having down payment, as well as a shortage of their inventory. So interesting things to watch in the housing market. And of course, as goes housing, as goes the U.S., so goes the U.S. economy, is one thing that we've seen decade after decade. Inflation, wow, 7% for 2021. Of course, the Feds are projecting a little tapering in that and probably only around 4% for 2022. But no one enjoys inflation. I know you can feel it if you've been anywhere near the pump. I filled up yesterday for the first time, and for the first time it was over $80 to fill up my tank. And that was just kind of one of those shake your head moments in my existence. I still remember the good old days when you had 25 cents a gallon gas, but hey, we didn't make the same thing then that we make now. So it's all relative, but it does open your eyes to some degree. Those inflation expectations, you can see the traditional Fed target of 2%, as well as the forecast of it getting down for 22, 23. We'll see how that goes over the coming weeks, and we'll go from there. The world's biggest companies are using their deep pockets and their sprawling global operations, the ability to command market share to more or less insulate themselves from what I'll call the supply chain meltdown. So they can digest their pricing and continue to raise prices to some degree. Which brings me to a discussion that I wanted to talk about is inflation investing defense. This has been a question many people have come up with recently as we've been having our reviews. And I want to look at what I'll call a Wall Street versus Main Street look at inflation. Wall Street, the large corporations generally find it easier to pass on inflation, just inflation-driven price increases to the consumer. And I'll share just a personal story with you. I was in Publix the other day, and one of the things on the shopping list was a pint of vanilla ice cream. And so I went to the ice cream section, and I know what is the pint sizes. I know what is the quart sizes. And I grabbed a pint of vanilla ice cream and didn't think about it. It was the same price it had been, a couple of weeks prior, I guess. And I just threw it in the cart. When I got home, I looked at it, and it wasn't a pint, it was 14 ounces. So what had happened is the ice cream manufacturer was now selling me 14 ounces for the same price that I could get 16 for not too far back. So it's a way to pass price increases on to the consumer that they never see. It's like, you open up the bag of air, and it's nice at the bag of air that sometimes they'll throw a few potato chips down in the bottom of the bag. It's kind of an interesting thing. You probably think I have horrible dietary habits right now. I apologize for that. Main Street, of course, small business meets the consumer face to face. And we all know that if we suddenly buy something today and we're face to face with the purveyor of that, and it was one price a few weeks ago or last time we bought it, and now it's substantially more, we probably make a scowling face of some type because we're disappointed. We don't want to see price increases. But Main Street has a little tougher time passing on those increases because, again, they're face to face with the consumer. Help wanted. It seems like every client I talk with has the same mantra. I'm looking for more good people. I'm looking for more good people. It's an interesting one. I ran into the other day was a shortage of daycare workers. I don't utilize daycare, obviously, but there is a tremendous shortage of daycare workers. As we know, daycare workers are on the lower end of the pay spectrum and have been staying out of the workforce, taking care of their own children. The result is workers who would like to return to the workforce can't because they can't find daycare openings. Just one more item, one more log on the fire, if you will, of why we're having trouble getting people back into the workforce. Looking at the trend in the unemployment numbers, unemployment is now lower than it was in March of 2020. Again, it's not the people in the jobs, it's the jobs available for the people and the people who are staying away from the jobs. But at least the trend is improving from an unemployment standpoint, but from an employment standpoint, of course, it's a challenge because you need people to meet the demands of the consumers. From a graphic standpoint, you can see that mild recession that we had, that was the influx initial side of COVID, but the unemployment trend is back down and is very, very low. Job postings is one that's always interesting. This is from postings from Indeed, if you're familiar with Indeed, and you can look back to where we crossed the line in January of 2021, and it's just been smoking as to the percent change of job postings of openings that are out there. So what's happening as far as average hourly earnings in different industries? As we see the kind of magenta right on the total private line is the education and health services. The demand for health service employees is still remaining strong. We see that the challenge they have, of course, is that is a skilled profession, and you have to have skilled people to move into it. We also have a number of people in those professions who are suffering from burnout or job change or moving into different areas. You see little change, of course, in the utilities and up at the top, the higher earnings, very little change because obviously you don't add a lot of jobs in those sectors. And then you look down in the bottom right-hand corner at leisure and hospitality, one of the lowest paid services that we get. But of course, that industry, as the hospitality industry is reopening, those jobs are out there with lots of opportunity for employment. But the scarce labor force really is becoming a fixture in the U.S. economy. We're reshaping the workforce and prodding firms to adapt by raising wages, reinventing services, and of course, investing in automation and technology. That's the big key. We're almost 2 years into the pandemic, and the U.S. is, of course, still missing millions of workers, and having to make up for that either through technology or an inability to service their consumer client customer. GDP, this is the number that was out this morning. GDP was up 5.7% last year. That's pretty robust, especially when you look that it was up in 19, down in 2020, and now we're back up again. So some quick math tells you it's almost 8% growth in GDP of 19 and 22 minus the 3.5. It gives you a little less than a 2% growth in GDP on the average, looking at the 3 years combined. So not dramatic, but at least as the 3 years it is on the upside. But what's the consumer thinking? Consumer confidence, or the conference board, tells us that the U.S. consumer is really feeling better about the economy. And surprisingly enough, look back at December of 2019, or 2020 rather, when we were at 88%. Now we're up to 115.2. We're expecting a little bit of a drop in January because of the increased amount of Omicron activity. And of course, there's this little bit of seasonal adjustment that goes on with the winter storms that come through. But overall, consumer confidence is still high. Leading economic indicators are still strong. And so the outlook that we have for the coming months, of course, is a continued recovery in the market. So we're hoping that the consumer will continue to drive the recovery, creating higher corporate earnings and, of course, higher employment as time goes on. New residential sales I touched base on, but I wanted to address this. The one key factor that my realtor clients are telling me is simply holding back new residential sales is inventory. We have the issue with new inventory that the appliances and other electronics within the homes are just a tremendous challenge, and we still have that problem of the strained supply chains being months out. I have this slide into the last fall of the number of container ships that are parked out in the Pacific trying to get berthed so that they can unload and then get those goods and services trucked or trained out of LA or Long Beach and reaching their way into the heart of America. It's just a perpetual challenge for them right now, and it's just really creating continued issues. So what we have is that situation that you may recall, there was a time before we had just-in-time inventory. And then we started the just-in-time inventory because we could get that. The supply chains were great. We had the globalization going on, and you could operate a business on just-in-time inventory. The challenge now is that to facilitate that, one of the things that was key was computer chips. And about 80% of chip production takes place in Asia. So pre-COVID, U.S. corporations would keep about a 30-day inventory of chips. And that was fine. You could meet the just-in-time situation. Now it's down to 5 days. So that strained supply chain is continuing to cause shortages of finished products. Right now, it's taking about 100 days to transport goods across the Pacific Ocean, which is about twice as long as pre-COVID. So it's just a huge challenge out there that will work itself out over time, but in the short run, it'll just cause inconveniences. So what do we have? High demand and low supply is always going to equal inflation because now there are fewer products to go to the consumer, and so the consumer will be forced to pay some more money if they want to be the one to get that product. So it's all about inventory, interestingly enough. I need to talk about taxes for a minute. The Build Back America plan, will it rest in peace? the general consensus is we will see some parts and pieces of the Build Back America plan. I think the plan at the multi-trillion level that was originally presented and massaged and voted on and debated, in reality, I don't think that we will see that hit an opportunity for vote in Congress. It is an election year, so there is the appearance that members of Congress need to do something so they can point to some successes over the last 2 years of why reelect me this November, that concept. But I think that act in its entirety and the far-reaching aspects of some of the provisions of that act, we're just not going to see. We may see them come up in 2023 after the midterm election, but we just don't expect that much in 2022. Investing in uncertain times, market fluctuations are a real deal. This particular graph is updated, as you can see, through the 25th, which was Tuesday afternoon. And you can see that the long-term trend, as Matt alluded to earlier, is still very, very strong. We looked at, yes, we're going to have temporary ups and downs. It looks like we've got that correction. I'll talk about that for a minute just to make sure you remember the definitions. That connect corrections or declines of 10% or more from the last high, but less than 20%. So between 10 and 20 is a correction. The minor ones of 5 to 10% you see in the blue shade on the graph. Bear markets are declines of more than 20%. They're in the reddish purple on the graph. And the number of calendar days that those particular declines lasted is posted below there. So when you look at the screen, of course, we all remember 2008, 517 days and a 56.8% hit. Wow, that was a tough time. But we have those little ones that are just the normal course of life and life in the market. So this week, the last week or so, last couple of weeks have been a real challenge. You see the futures in the mornings and you never know what the market's going to be like by the afternoon. It's a little wild and crazy because, again, one word, and that's uncertainty. The market hates uncertainty. There was the uncertainty coming up this week of what's going on in Russia, the uncertainty of the COVID numbers, the uncertainty of the Fed interest rate adjustments that were announced yesterday afternoon. All of those factors lead to volatility, and that's why we've seen a lot of volatility this last few days. So what do you look for? Buy companies, not headlines. I have to ask you this. I'll pick on companies that provide things like paper towels and toilet paper. Does what's going on in Ukraine and Russia impact your purchasing of paper towels and toilet paper? Probably not. So if you can find a company that makes a great income with consumer products along that line and pays a nice dividend, you probably want to stick with it. So looking at the company, not the headline. Be an investor, not a trader. You know, I know a few people who are traders. They're in the market every hour of every day when it's open. And the reality is it takes a strong stomach for that because as we've seen over the last few days, hey, 1,000-point swing, no big deal. So stick to your plan, stay in your long-term lane. Again, we're talking about financial planning and achieving financial independence. Avoid those emotional decisions. You know, you wake up in the morning, you see the futures are down several hundred points, and it's like, oh my gosh, I can't handle this. I need to get out. No, take a breath, stay calm, watch ESPN for a few minutes. Diversify, because we never know who the new winner or who the leading company is going to be. And of course, monitor your portfolio regularly, just simply so you're protecting your piggy bank. So the things you should be doing right now, very important. Work to achieve the overall financial independence. Take time to review your overall financial plan. You know, if you've been able to struggle through the horribly low interest rates on CDs and bonds over the last few years, And now it looks like that trend may begin to reverse a little bit. Maybe it's time to look at the financial plan again. Maybe it's time to go back a little more into bonds and other fixed income instruments. Keep in mind, we don't think the Feds are through raising interest rates for the year. So do things from a short term, not a long term standpoint on fixed income. Risk management and insurance. You know, the value of your home has probably gone up dramatically the last 2 or 3 years. When was the last time you took a look at your homeowner's policy to make sure you're adequately covered? Retirement planning. Are you saving money in the right places and taking opportunities of every opportunity to put money away for the rainy day? And number 2, save some taxes. Look at coordinating your risk, that risk versus reward, that equity versus fixed income balance. Education planning for children or grandchildren. Of course, being CPAs, we're always focused on minimizing taxes. So that's very important for us, is to minimize the income tax. Now we have this new tax called inflation that, of course, reduces your purchasing power, and estate and death taxes. We dodged the Build Back Better changes to the estate and death taxes for 2021, but we know there is an incentive to change things 2022 and beyond, and of course the current rules expire in 2025. Always check your beneficiaries to make sure they're who you want to receive your estate if something should happen to you, and review those documents. So it's time to ask the expert, and Matt, let me get you back up here. Let's see. I need your help answering a few of these questions. And let's see. Pardon me a minute while I get Matt back up here.
I'm here, Marshall.
Oh, great. Thanks. Matt, got a question for you. It appears that interest rates are on the rise. What measures should we take to deal with this?
Absolutely. Interest rates are definitely on the rise. And there are a couple of important things that you could do both to protect your financial health and to protect your portfolio. If you have debt, you want to make sure that you are locking in today's rates. For example, a mortgage. If you have not refinanced your mortgage in the past couple of years, you need to take a look at that and make sure that that you're locking in today's rate for as long as possible, rather than being forced to do that later at higher rates. On the flip side, as an investor, when we think about our investment portfolios, we want to keep the duration of our bond investments short, because we're going to be able to reinvest proceeds at higher interest rates in the near future. So if you're simply buying a bond index, the indexes have very long duration, because most of the debt market, investment grade debt market, is long duration government bonds. If you think loaning money to the U.S. Treasury for 20 or 30 years at 3% or less is a good deal, then go for it. But when we could see short-term interest rates approaching those levels in the next year or two, we certainly don't want to commit our capital to those kinds of bonds for a multi-decade period. So again, being very careful and continuously monitoring our portfolios is the other key aspect of it. Simply watching where rates are going, what the Fed is doing, and monitoring our portfolios to make sure that our investments are appropriate given that interest rate cycle that's coming up.
Matt, let me piggyback on that. What types of investments yield the greatest return in the shortest period of time, and the risk rating?
Yeah, that is another excellent question. And really the question isn't how can I make the most money the fastest in the market? That's the trader's mindset or the gambler's mindset. We approach things with the investor's mindset and with the financial planner's mindset. So we think about what kind of returns do I need in order to make my financial plan work, to get me from where I am to financial independence, or keep me financially independent. And then we want to take the right amount of risk so that our investments will give us the returns that we need in order to make that happen. So it's kind of the inverse thought process from the gambler or the trader. But that's how we approach investments and the capital markets. When we think of risk, the conventional definitions of risk are um, less useful from a financial planning perspective. And we really need to think of risk in terms of, are the companies we invest in going to be able to continue to make money given where we think the economy is going over the long term? And the true risk, of course, is that companies will stop making money for some reason or another. And that's the one that we guard against, not the risk of the market having a correction this week or next month.
Okay, which leads into you're dovetailing into some of these that I got here. I apologize, but I'll keep you on because it dovetails. Considering what appears to be less spectacular but still positive earnings for 2022, compare growth versus dividend stocks.
Yeah, absolutely. So, value stocks or dividend stocks have performed fairly well over the past couple of years. And what we see on our own portfolios is that when the market is frothy or there's a raging bull market, growth stocks tend to outperform value stocks a little bit. But when there are corrections like the one we've just had, the kinds of portfolios that we build tend to weather the storm far better than the broad market indices. Not to name any names, but there are some technology funds out there that were very popular up until recently, and they were investing largely in companies that were unproven, that had little or no revenues, that were unprofitable, that were actively burning capital rather than creating capital. And of course, some of those funds are down as much as 50% year over year compared to the market indexes, which are still performing well, and benchmarks composed of stable companies with stable earnings that we invest in, which are still performing reasonably well.
So my last follow-up on that, is there any change in your investment strategy going forward into 2022 versus 2021?
Yeah, we don't anticipate any further changes to our investment strategy. We think that we're fairly well positioned when it comes to the incoming interest rate hike cycle. A lot of what will cause volatility in the markets this year, meaning geopolitical instability and politics, really isn't that germane to us as investors. It's something that we're going to continue to monitor. Policy changes can drive the markets. Politics will simply cause volatility, and we don't change our investment strategy as a result of politics.
All right, very good. I'll hit one specific to retirees. Have you changed any of your asset allocations recommended for retirees? Well, for some time now, we've been leaning toward dividend-paying stocks versus fixed income. Fixed income yield had been so anemic, and retirees needing cash flow and facing higher inflation, the dividend-paying stocks have been the opportunity for better return for those clients and to support the cash flow needs. Speaking of cash, in these times, how much cash should you have on hand? Well, a general rule is 6 months living expenses available in cash. It just depends on the reliability of your income stream and general financial condition. Let's say, for example, that your income is Social Security and maybe a pension and your required minimum distribution from your IRA. Well, that's a pretty safe income stream, and so you wouldn't be inclined to have even more months of living expense in cash because the chances of your income stream falling off are much less than someone who's in a face-to-face sales job that requires or that generates commission income. As we all know, those face-to-face meetings can come to a grinding halt in a very short period of time. So the smaller the safety net, the greater of length of time you want to have covered. But 6 months is a starting point for looking at your given situation. The chat box is still open if anybody has anything else that they'd like to throw in, but I do have one last question, and I love this one. Will the uncertainty and volatility of the markets continue during the balance of the Biden administration? Well, the answer to that, and I'll steal from Disney, yes to infinity and beyond. Matt's slide that said there's always a reason not to invest in the market. You saw that a few minutes ago. I love that one because having been in this business for several decades, I can always tell you there is always a reason not to invest in the market. The naysayers are always there. So uncertainty, volatility, and change are just factors of life. I always like to pose the converse question: when was there not uncertainty, volatility, and change? It just seems like that's just how it goes, and we live with it. But history has shown us that if you can tolerate that, your opportunities for reward are very, very good. So last call for questions, but let me continue on. If you know someone who would benefit from the webinar, we'll be offering a recording of today's presentation on the Gunn & Company YouTube channel. Once it's posted, we will email a link to all registrants. So you'll get one of those later today. Be watching your email. Feel free to share it with your family and friends. Since there are no final questions, just a quick reminder, our next scheduled event will be our Q1 2022 economic update. That'll be held Thursday, April 28th, 2022 at 10 a.m. I certainly hope you'll be there. I'm sure with the way this quarter is starting off, it will be interesting. Thank you for joining us. We look forward to meeting with you soon. Stay safe, stay healthy, and we wish you all the best for 2022. Thank you.